Someone reached out to our office who was interested in a whole life insurance policy. He let us know that he was interested mainly in the long-term efficiency of the policy and that he wanted to use it for infinite banking. So what we're going to do in this video is go over first the goals he provided to us, and then second, the different policies that we prepared for him. I'll go over the different options, and then I'll let you know which option I would pick if I were him. So to kick things off, he's interested in a whole life insurance policy. He let us know that he doesn't really care about the death benefit and that he wants to push that as low as possible in order to minimize his costs. The upfront liquidity, which means cash value during the early years, he said is not a big concern. However, the long-term cash value is really what he's interested in. And then the big piece for him is flexible payments. Now, he has done a lot of research, and I absolutely loved what he provided because it let us prepare everything for him before we even met. Here's what he wants to do. The first 10 years, he let us know that the minimum amount he'd pay in is $25,000, and the maximum is $75,000. So he wants a policy where he can pay in somewhere between that range, meaning I want to be able to pay up to $75,000, but make sure I don't get a bill for $75,000 every year. I want it flexible. Now, the next 10 years, years 11 through 20, he knows that his income will drop a bit, so he wants a minimum of about $15,000 and his maximum to be $50,000. Here's an important point to mention. If you tell an agent what you want your minimum to be, what you want to look out for is that they don't just set your base premium at that minimum amount. The base premium is what drives agent compensation. And if you say, I want this minimum premium, in many cases, that is interpreted as set the minimum base premium there. That is what a manager at an agency would tell me if I'm young Steve saying, here's what someone said. They'd say, set the base premium here. That's what drives agent compensation. Here's what's important to be aware of. And we went over this with him. The rules of the game. So we looked at two different life insurance companies, Guardian and then also Mass Mutual. With a life insurance company, my money can go toward the base premium or the PUA rider. Base premium dollars first buy life insurance and do not show up in cash value, whereas PUA dollars do. With Guardian, wherever I set that minimum premium, I can illustrate 10x that per year in PUAs. The exception is in the first year, if I have a lump sum, I can actually go as high as 50x that. Whereas Mass Mutual is 10x every year. So what I would do here, if I'm him, is if I knew that the most I ever want to pay into a policy is $75,000, I would set my minimum premium not at $25,000, not at $15,000, but at $7,500. About 10% of that $75,000 figure. And the reason why is because it allows me to get more money into PUAs. So for example, if my minimum on any given year is $25K, but my true base premium is $7,500, that means I'm putting the majority of that $25K toward PUAs. Does that make sense? I'm going to push the base premium lower. So that's how I would set up any policy. Now the premium and PUA limits are important, but that part is important to be aware of, especially if you tell an agent what you want your minimum to be. So the products that we're going to look at, because he wants to fund for a maximum of 20 years, are Guardian's L95 product, and then Mass Mutual's high yearly cash value product. One thing that I did mention to him would be, hey, if there's any chance you might want to fund a maximum of 15 years, you'll find that their 15-pay product will deliver a significantly higher internal rate of return, meaning rate of return on cash value, than their high early cash value product, which is a good thing to be aware of. But he knows how long he wants to fund it, 20 years in this particular case. So here's what we went through. Looking at the two different companies, With Guardian, the true minimum is going to be higher than the $7,500 base premium. That's the base premium, but we'll also have term insurance. The minimum's going to come out to a little bit less than $10,000. But that's his true minimum commitment on a yearly basis. Everything above that goes into PUAs is 100% optional. So if he said, the most I ever want to pay in is $75,000, what he can do with Guardian is set it up where he's only committed to the $10,000 per year. He's billed for that. He can even divide it by 12 months if he wants to. And then 100% at leisure, he can add up to $65,000 per year, but it is optional. And how you actually add those dollars is by going onto your online portal, mailing in a check, could be your mobile app, wire transfer. You could add $1,000 per week, $10,000 a month. Literally, it's however you want. It's like throwing money into a bank account. It's very flexible when it comes to their PUA rider. And flexibility of payments was very important to him. So we want to go over those details. MassMutual, on the other hand, his all-in minimum with the premium plus the cost of the term insurance rider comes out closer to about $9,000 just with the way we can structure the policy. However, the PUA rider, it is optional and it is flexible in the sense that he can adjust it every year. But here's the thing. It has to be paid the same time as the premium. So what this means is if the first year he pays $75K, that means $9K was his premium, his minimum, and the other $66,000 was his PUA payment. If the second year he says, hey, things are slower, I want to pay in just my minimum of $25K, well then we would make a manual adjustment with MassMutual to reduce the PUA piece to $16,000 because $16,000 plus $9,000 is $25,000. And then if you wanted to increase it, we'd have to wait until year 3 on the premium due date. So you do have PUA flexibility with MassMutual. The big difference is to make life easy for you without having to jump through underwriting and paperwork and all that extra stuff, one time per year is when we can make those payment adjustments in a convenient manner. Whereas Guardian, I just commit to the minimum and add more to my discretion. All right, let's take a look at the numbers. So here's what we built out for him. With Guardian, we looked at 2 different versions of the product. He mentioned he's more interested in long-term cash value, not so much upfront liquidity. At the same time, it's still beneficial to show that, in my opinion, because where buyer's remorse comes into play is when you ask for something and then I just put together what I think you'll probably like. Yeah, I can probably guess that from doing it for a long time. But at the same time, if I don't show you an option that maybe you didn't know to ask for and you find out about it later, that's where just the due diligence and always acting in the best interest of the consumer comes into play. So here's the true base premium. With Guardian wanting to fund for 20 years, not quite $7,500, but as close as I could possibly get it. So close enough there. Here's the cost of the term insurance rider. So the true minimum are those 2 combined. So less than 10K, but if we just round up, it's about 10K per year. And then you've got your PUA rider. There we go. Add the base premium plus the PUA. It gives you 75K because the PUA rider actually covers the cost of the term. 75K per year. There's your cash value column. We're going to look at this on Excel to make it easier. What I'll just highlight quickly is the fact that we fund it for 20 years. Now, what do you notice here? First 10 years, funding 75K. Next 10 years, funding 50K. Because he mentioned that his maximum for the first 10 years was 75, and his maximum for the next 10 was 50. Whenever we're building out a policy to be very flexible like this, I always want to solve it for the maximum first. The reason why is because if the illustration can handle the maximum, without turning into a modified endowment contract, which equals taxes, or without the term rider burning out, which would force him to pay a lower dollar amount, none of that nonsense, then I know it can handle it. And if he pays in less, there's nothing to worry about, like we're good. The big thing is making sure that it can handle the maximum so he doesn't have buyer's remorse and it's very easy to pay in less. So we built this policy so he would have the ability to fund it at the maximum amount that he feels that he might be able to do. Then what we did is looked at the exact same product. Just take note of this STP. Watch what happens when I go to the next illustration. It's a different PUA fee here. It's a higher PUA fee, which gives me less liquidity up front, what he asked for, and more cash value long term, which is what he's really interested in. So we're showing two different versions of this product, and then also the high early cash value product with MassMutual. And you'll see the same thing, 75 per year for 10 years and 50 per year for the next 10 years. So to simplify this, let's take a look at everything side by side. So first, we've got Guardian. This is what we looked at. His all-in minimum, about 10K, actually a little bit less, but then the rest goes toward PUAs. Add them together, there's your total annual funding. The total funding tallies up all of his payments year over year. So by the fourth year, 75 times 4, 300,000, it's a 298. So close to breaking even. And year 5, he's positive. All right. A lot of business owners love this product because it allows them to commit to a small minimum premium, add extra funds when their cash flow permits, and I see it break even early, which for a business owner, that's an opportunity cost. I don't want to see it take a long time just to get my money back. That's where business owners say, I'll just keep it in the bank because there's more liquidity there. So fund it for 20 years. He doesn't have to fund it for 20 years, by the way. If he changes his mind and wants to stop after 4, he can do that with all 3 of these options. But let's look at the next version. Same product, but with that higher PUA fee. 10% has to do with the paid up addition fee that's attached. And what the insurance company says to us if we go with this option instead of 5% is we're going to take more money from your PUA payment up front. You can see that here. He's got 60,000 instead of 64,000. And then instead of getting his money back between 4 and 5 years, he gets his money back between 5 and 6 years. That's because the insurance company is taking more of his PUA payment up front. It's not available for him. But the reasoning behind that is the insurance company says, if you give us more upfront, we're going to go out into the marketplace with that money, and then we feel we can earn a higher return, and we should be able to give it to you back, plus a lot more long-term, based on the non-guaranteed dividend. But it is non-guaranteed. You will see the guaranteed values look better with this option. So when we compare these two, long-term, I should say short-term, which one gives you more? This one. Long-term, year 20, $1,957,000 compared to this guy, $1,908,000. A 50K difference. What about by age 70, which is year 27? He's no longer paying anything. 2,585 compared to 274. So not quite 200,000, but we're seeing a difference now. So showing both of these options allows him to see everything up front. And based on his goals, you probably know which one he's going to lean toward. And then lastly, we've got the high early cash value product with MassMutual. As long as he's good with the flexibility, or I should say lack of flexibility compared to Guardian, like if he knows what his cash flow is going to be, this one can work well. With the way that we have to build a Guardian policy when somebody wants to fund for a long time, we got to put a big term rider on it. Like look at the death benefit on the Guardian option. This is us minimizing it too, so he can fund it how he wants for 20 years. And compare that with MassMutual. One of the things I like to tell people whenever I'm like going over different products with them and they ask me, hey, Guardian's got this flexibility. Like, where's MassMutual's advantage? My answer is, one, if you like size, right? If the company size does matter to you, MassMutual is massive. I'll call them massive MassMutual. And then second, their products, just with the different term riders and such, really allow me to design it in a way where I don't have to overinflate that death benefit from the beginning. It grows over time. By the 20th year, I should say 21st year after the funding, it's very similar to the Guardian example. But I can start out lower, which does keep my costs lower. That's the main reason why the minimum here was $9,000 when we factor in that term insurance rider as well. But anyway, it really accommodates a long funding period. If you wanted to go 30 years, I would really lean toward Mass Mutual in this particular case. Also, break even, clean year 4. First year cash value is 69, where he paid in 75. So he's got a lot of upfront liquidity, even though he said he didn't need it. But when we look at this long term, compared to the other guys, it looks even better. Now we're comparing two different companies that I've seen always seem to work out in the wash over time. Not much difference between the two. But these are the different options. Which one would you pick? If you say, I don't know, my encouragement would be to progress to the flexibility. Is funding one time per year something that you're comfortable with and making that adjustment one time per year? Maybe it's 75, next year it's 50, next year maybe it's 15, then you go back up to 50. You can do that kind of stuff, but just one time per year. Or does the thought of only having one shot to do it without underwriting make you say, that's going to annoy me? And if I want to throw extra money in, I'm told, no, I got to wait. If that doesn't work, I've seen people try to force it. They get frustrated. That's where I'd progress to Guardian. Because I can commit to a small amount and dump in extra funds at my leisure. And again, we're focusing on the funding here. We're not talking at all about the loan feature, which we would also discuss. But of these options and his particular situation, knowing a bit more than what I discussed in this video, I lean toward that L95 with the 10% PUA fee. Because he's not as focused on the upfront liquidity, he wants the long-term cash value, and payment flexibility is very important to him, and this will accommodate that. The last thing that I will mention is he also is looking at a business policy which will give him more upfront liquidity, which makes the long-term option even better in my opinion. Hope you enjoyed this video. I'd love to know I'd love to hear your thoughts. Please leave them in the comments below. You can also email me direct or reach out to our company. And if you'd like to see options like this, or if you'd like a second opinion on any policies you have or are reviewing, please feel free to reach out. As always, I hope this helps.